Hello everyone. In our June quarter update, we noted that financial markets had largely pushed global inflation worries to one side. Moving ahead just 3 months, and several key reserve banks are rethinking their view that inflation is temporary, and perhaps now thinking that inflation could be around for a while. Firstly, the Reserve Bank of New Zealand increased its cash rate to help control inflation, even though Auckland remains in COVID lockdown. The Reserve Bank of Australia adjusted its outlook and may consider cash hikes in 2022. And finally, the US Federal Reserve has updated its guidance, announcing an immediate reduction in asset purchases. These developments have accompanied sharp increases in bond yields, with some of the largest moves occurring in the New Zealand and Australian bond markets. It's worth noting that an increase in bond yields is negative for short-term bond returns, and the global bond market returns were stagnant over the quarter, partly for this reason. Now turning to shares, and the New Zealand share market was amongst the strongest for the quarter, reflecting its robust company reporting period. On the other hand, global share returns, as measured by the MSCI World Index, were flat, but received a small assist from the falling NZ dollar. At the lower end, China and developing countries at an early stage in their vaccination journeys were amongst the weakest performers. So let's turn to the returns achieved by our investment managers, and Aon KiwiSaver Scheme investors remain well rewarded when investing in higher growth, higher risk strategies, and these are at the top of the table. Even so, returns in the September quarter continue to moderate compared to previous quarters, as economic growth might be peaking and government stimulus is starting to be withdrawn. This shift is in line with our prediction that supersized returns seen across the past year are unlikely to be repeated. We are watching developments in Chinese economic growth prospects and the Chinese government's handling of the unfolding property development crisis. We believe China will do what's necessary to avoid a disorderly collapse of its property development sector. This won't stop the rapid slowing of the sector and will result in lower Chinese economic growth as a whole and weaker commodity demand. Energy shortages leading to reported manufacturing shutdowns just adds to our concern. Our outlook focuses on inflation and economic growth risks, which seem likely to dominate the headlines for a while to come. How reserve banks manage the withdrawal of their stimulus will be watched closely, and both bond and share markets may be volatile as a result. And while we do not believe large share market falls are imminent, we do expect share price growth rates to moderate and slow. If you haven't looked at your Aon KiwiSaver Scheme investments recently, then maybe it's time to do so. Check out your account balance online or look at our investment returns on our website.